In my first year as CEO, we set out 3 strategic priorities. The first of those was to make sure we got the best profitable growth rate in Ferguson. That really means growing Ferguson north of the market growth rate. And I feel that we've made really good progress in that area, particularly in the second half of the year when growth was over 8.5%. The second strategic priority last year was to start the UK transformation, which we set out to shareholders last year. And we made some really good progress there in reconfiguring the branch network, in the supply chain, making sure that we've got the right product range, moving to in-night deliveries. We made some really good progress on the UK transformation. The third priority that we set out last year was to review the operating strategy of the Nordics business. The team did a very good job reviewing the strategy and actually starting to implement that strategy. We made the decision during the year that we were going to exit the business in Nordics, and we made good progress with that project so far as well. During the year, we made 2 really important additions to the board. Kevin Murphy as the CEO of Ferguson Enterprises and Mike Powell as the CFO of the business. 2 things really. It's great to have the talent from within the pipeline in Ferguson Enterprises so that we can bring fantastic talent to the board. And also it's great that we managed to introduce Mike from outside the company. We really are an employer of choice. It's been quite a busy year on the corporate front because in addition to our strategic priorities last year, we also made quite a few changes on the corporate side of things. For example, we decided to move to dollar reporting because most of our earnings are stated in US dollars. And importantly, we decided to change our name to Ferguson PLC, just reflecting the strength of Ferguson in the US market.
Group's had a good set of results. We've increased our revenues up some 8.6% to nearly 15 billion. We've improved our gross margins and at the same time continue to invest in our overheads as we look to grow the business in future, and that's led to a good improvement in our trading profit to just over £1 billion sterling. Also importantly, we had a very good cash performance in 2017. We had good working capital performance. And of course that cash has been reinvested back into the business through both capital expenditure and through acquisitions. And that's left us with a good strong balance sheet with net debt to EBITDA at about 0.5. US performance was very good. It's our biggest business, accounting for nearly 90% of the group's trading profit. The sales grew strongly, over 10%. At a constant currency basis, and that allowed us to grow our trading margins about 8%, just north of 8% year on year. US flow-through was weaker than the usual guidance over the whole year. That was very much skewed to the first half. We had a good recovery in the second half. Whilst the long-term guidance for flow-through is low double digits, it's important we continue to invest in our business, and of course in the short term that has an impact on the flow-through, but is absolutely the right thing for us to be doing as we continue to look to grow our business. During the year, whilst we have seen volumes decline, we have still managed to move profits forward, some 2 million sterling in the year, and that's really been driven by our pipe and climate, our infrastructure business and our online business, soak.com, and that's really been offset by the plumbing and heating business. Canada and Central Europe performed well. In both the businesses, the markets are fairly good, and we managed to perform well in terms of our revenues. Margins were fairly flat, but good cost control allowed us to grow our trading profits in those businesses.
Most of our customers are not simply interested in a buy-sell transaction. What they're actually interested in, they're executing a project. They're either building something, renovating something, installing something, and their wants, the customer wants, are actually quite complex. It's important for them to be able to order at the right time. It's important for them to for the product to be delivered at the right time. Very often they need quite a lot of advice. They may need us to source product. They may need specific delivery requirements. So all of those wants are actually quite complex. This is not just a transaction. We're helping them to fulfill their project needs. We have a really compelling range of service offerings. That's what we're doing today. We need to make sure that we continue to invest in those things and do them absolutely as well as we can. And we also, at all times, need to stay really competitive on price. We get asked a lot about the competitive landscape in the online arena. And it's absolutely true. It is a very competitive landscape. Build.com, which principally services B2C consumers, that is a very competitive landscape. We have to be very competitive on pricing, and we are very competitive on pricing. We've also got a very strong service element to our offering in that space. But the competitive landscape remains just as strong as ever. Over the last year, the US residential market continued to perform very well. Good growth in US residential, actually very decent growth as well in US commercial markets. The market that we struggled with a little bit towards the start of the year, or coming into the year, was the industrial markets. But it's good to see in the second half of the year that demand in the industrial segment has recovered. So I think overall today we would characterise the US markets as being good markets in which for us to operate. And that's really reflected in the strength of our order books, which are continuing to grow, really commensurate with a decent single-digit growth. It's great to see the Ferguson growth across the US, coast to coast, in all four of our regions was good during the year. There were no real areas of weakness, and all of the business units continued to grow pretty well throughout the year. One highlight, I think, during the year was now we're pushing on again, both in B2B and B2C e-commerce, which now represents 22% of overall revenues in Ferguson Enterprises. This time last year, we set out a detailed plan to transform the UK business. We're a year into that plan today, and we've seen some good progress. The reconfiguration of the branch network, the supply chain. We've done a lot of work on supply chain, for example, moving to in-night deliveries. A lot of work on the range. It's important that we've defined the range and we've got a really good, clear range that our customers want. And then the rollout of things like sign-on glass technology. We feel very good about that. But it is early days. We're 1 year in to what's essentially a 3-year transformation project. At the start of the year, we agreed that we were going to review the operating strategy for the Stark Group. And that was a process that took us about 6 months at the start of the year. The team really engaged well in that strategy review process and have got now, I think, a really clearly defined and very good executable strategy that will serve that business very well going forward. We also decided during the year that we're going to exit the Stark business. We've had a lot of really good interest in the business. We're executing that sale process now. We'd expect to agree a transaction with whoever's going to buy the business before the end of this calendar year, and to complete that transaction sometime in the new year.
As I came into the business, it's important to look at the capital structure, and we have a good balance sheet. We throw off nice cash, and we have 4 main uses of the cash, and in terms of the order of that, we'll redeploy that cash for organic growth. We then have a progressive dividend policy, which over the long term matches the earnings growth of the business. We'll then use cash for acquisitions that we see fit, which we have strict controls over. And then lastly, if we have any cash left over, which we can't deploy for any of those 3 items, then we'll return those back to the shareholders. And in terms of our leverage, I believe it's entirely appropriate to have a business that's run in the region of net debt to EBITDA of 1 to 2 times through cycle. In terms of capital returns, we increased the dividend 10%, and also with the results we've announced a buyback of 500 million sterling. We believe a buyback is quick and simple to execute and also creates shareholder value. We'll also be declaring our dividend in dollars at the next dividend declaration date, and shareholders will have the option to take that dividend in either sterling or in dollars.
Overall growth in the new year to date has been about 6%. Remember, that's been affected marginally by the hurricanes, so that's good growth. And actually, market conditions across pretty much all of our markets today, residential, commercial, and industrial, are good. So we need now to push on and continue that growth into the year ahead. For all of our associates across the group, last year you delivered both for our customers and for our shareholders, and I'd like to say a huge thank you to you all for that delivery.